This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to the show. I got an update for you this week on some of the housing data that's coming out of the GTA and in Greater Vancouver, where I am, and also some bank earnings. Going to go over that, how that's impacting the mortgage market, the issues that I think are starting to build behind the scenes for the Canadian household. The stress that emanates from interest rates going up, 400 plus basis points in a span of less than 12 months. So we're going to get into all of that this week, but I think you have to start this week off with, really looking at the housing data. We had some figures coming out of the GTA, home sales down 51% on a year-over-year basis. Now, again, keep in mind, 51% of volume getting cut in half. Of course, it's coming off an all-time blistering hot bull market. So the base effect from last year, obviously very, very difficult to beat. February was the ultimate peak of the housing market across the nation. So those year-over-year figures look horrendous. GTA home sales again down 51%, the lowest, second lowest, I should say, in 20 years. And it's a similar story in Greater Vancouver. Home sales were down 47%, kind of muddled along. 2019 was worse, 2012 was worse. But overall, a pretty weak month. Now, the sort of caveat, or I should say the asterisk that's next to that number, is that in the GTA, you had a 20-year low, 20-year low in new listings. Here in Greater Vancouver, you had the fewest number of new listings for the month of February in 26 years. 26 years. Again, I'd love to remind everybody that, who had that on their forecast sheet heading into 2023 as the outlook towards the end of 2022, extremely pessimistic, everyone banking on more homeowner stress, listings and inventory building up and putting more downwards pressure on prices. And that's exactly what hasn't happened, at least not yet. And again, not to say that it won't happen, but I personally am surprised. I did not have 26-year lows of new listings on my sort of, bingo sheet, as they say. But that's exactly what's happened. Now, I have some reasoning for that, which is ultimately when you're, sellers, there's a lot of sellers out there that don't like the current market conditions. As we've talked about in the show before, if you look at owner-occupied housing in the city of Vancouver, primary residence owner-occupied housing in Vancouver, 50% of these homeowners are mortgage free. They have no debt, so they're not in a situation where they're pressured to sell, particularly into a weakness market. Not only that, but the people that then need to sell, they need to buy. They need to move somewhere. They got to move. So number one is the rental market stinks. So if you're going to sell and cash out, and you got to go to the rental market, pretty tight rental market. Number two is people, when they're thinking about selling, they're usually actively looking. And a lot of times, depending on your financial situation, you'll go and you'll buy a property first. And so you're looking out there and you're saying, well, I'm scouring the MLS every day. I haven't found anything that I actually want to go and buy. So why would I list my house for sale? So it's kind of this catch 22. And at some point it will resolve itself. That's sort of the reality and the anecdotal conversations that we're having with homeowners on a day-to-day basis right now in the Vancouver housing market. So that's number one. And so when you have this situation where, sales are weak, there's not a lot to sell and people either. So you've got, weak sales volumes. And so what we're seeing now basically is you're seeing prices are firming up. Again, you can
shoot the messenger, totally fine. I have plenty of anecdotal stories, one of which I'll share with you. There's a house in North Vancouver sold last year in the month of November for 1.4 million. Older house, tear down, or not, I wouldn't say tear down, but an older, not a very great house, but sold for 1.4, kind of sat in the market, estate sale. Someone said, hey, you know what, let's get rid of it. It just relisted on the market a couple weeks ago for 1.6. What are we, 3 months later? Sold 1.585. So, $185,000 lift in the span of 2 or 3 months. That's what we're seeing in the market, is a lot of product that couldn't sell last year is now selling this year, and arguably at higher prices than what they were selling for 3, 4, 5 months ago. And that is, I think, predominantly due to the crunch in inventory. It has less to do with this feverish demand that is building in the market. Now, certainly demand has picked up off of near multi-decade lows, but the reality is that this inventory problem is continuing to be an issue. And so if you're waiting and hoping for lower prices, you need new listings to come to market. And so one of the things that I'd say to watch for, and I think this is going to take months and months and months and months and months to play out, but it's something that I'm keeping my eye on, which is look at the bank earnings reports. And in those bank earnings reports, it will tell you some important subtleties, which is these banks are basically allowing to sort of pretend and extend. They are allowing people to, these people that are on, let's say, variable rate mortgages, basically banks are saying, listen, you don't really have to increase your payment. You can just pay it interest only. We'll tack it to the balance. We'll extend the amortization. And so people that are in sort of, financial distress from surging mortgage payments and interest rates, they are essentially being pushed down the road. So, for example, if you look at the recent report from CIBC, in their bank earnings, it says that 20% of their residential mortgage portfolio book, 20% of those mortgages are not even, their monthly payment is not even covering all of the interest. So 20% of CIBC's residential mortgage book, 20% of those borrowers are not even paying enough to cover the interest on their mortgage. And so what's happening now is the amortizations on these mortgages are basically accumulating. And if you look through the report further, both CIBC and TD had the reports out that just over 25% of their entire residential mortgage book has amortizations greater than 35 years. So last year, that number was essentially zero last year. Now this year, they have about just over 25% of their book has amortizations greater than 35 years. And so these amortizations are basically growing as no principal gets paid down on these variable fixed payment mortgages. And so the issue lies here was it doesn't create sort of this distress selling, at least not yet, because what's going to happen is basically, assuming there is no policy changes to sort of try to sort this out, and assuming rates sort of stay higher for longer, which is certainly one of our concerns, is these people that have these amortizations that are growing. So when you come up for renewal, when you come up for your, you had a 5-year variable and that comes up for renewal, they're going to say, okay, well, when you initially took out this mortgage, you had a 30-year amortization schedule. You now have 25 years left because 5 years have elapsed. However, your amortization has grown because there's been no principal that's paid off. Your amortization has grown to 40 years. And so what you're supposed to do is you're supposed to fit that remaining balance into the remaining term, which is 25 years. So you'll have this large balloon payment, which I can tell you for sure a lot of people are not prepared for, because most day-to-day mortgage holders aren't equipped with this information. I mean, there's not enough people, watching this channel and reading the news and actually, having deep conversations with mortgage brokers about the future of their mortgage. People just look at what they're paying and just say, I'll figure it out when it comes up for renewal. So that's going to be the issue. That's going to start to be when it starts to put pressure on the industry. Now, the second thing I'd say to keep an eye on is we had a data point released from the mortgage regulator, the broker regulator in Ontario, where it showed in 2021, 1 in 10 mortgages that were originated by mortgage brokers in the province of Ontario, 1 in 10 mortgages that were originated that year were private mortgages. So these are high interest rate mortgages that are typically on 1 to 2 year terms. They typically have a fee up front. So it's basically, think about like you could be borrowing from a bunch of lawyers, you could be borrowing from a small mortgage investment corp is what they call it. So, if you had borrowed on a private lender in 2021, chances are if it was a first position mortgage, you're probably paying 6% plus a 1%, 2% fee. And let's say that renews this year. That rate wouldn't be 6% today. You'd probably be looking at about 10% today. So, and keep in mind, people that typically take these private mortgages because you can't get traditional financing from the big banks. But the idea and the hope is that, well, so long as the value of your home goes up, your income grows, your situation will be better in 12 to 24 months. So you can then pay off the private lender and roll into a loan with a traditional bank at a obviously more conservative and acceptable mortgage rate. So you can clearly see that there is a cohort of the Canadian housing market, Canadian households that have stress and pressure building, but they're sort of allowing to sort of push this out. And so the day of reckoning is certainly coming, as so long as rates stay high enough for long enough. Okay, so if mortgage rates, for whatever reason, inflation comes down faster than anticipated or what have you, the markets right now are pricing in 200 basis points of rate hikes from the BOC in 2024. If that actually comes to fruition, mortgage rates actually come back down, a lot of these issues will sort of resolve themselves on their own. But should they not, or should they stay more elevated, these are going to become real concerns. Now, the one thing I'd like to also say, with the caveat, again, don't shoot the messenger. Let's keep in mind here that the banking regulator, which is OSFI, is obviously aware of this, okay? The banking regulator, OSFI, works for the big banks. They work for the 5 banks. The big 5 basically run the Canadian economy. Let's call a spade a spade. And so there's really nothing stopping OSFI from, all it takes is a stroke of the pen to say or suggest how these mortgages should be dealt with. Okay, so there's not going to be this OSFI not just to go, yep, you're good, just everyone's going to default 20% of the book, and the big banks are just going to get absolutely crushed, and there's going to be these mass foreclosures. OSFI, which is in charge of financial stability, that's their sole basically mandate, is financial stability, probably isn't going to just let their hands up. Now, it doesn't mean there's not going to be pain, but we also can't be naive to suggest that a lot of how these mortgages are dealt with can't really be fixed by the stroke of a pen. So if it really builds into a major issue, we have to be cognizant that there's probably some sort of policy intervention to some extent. Now, again, this doesn't mean that you're not going to get distressed sellers. It doesn't mean that you can't have an accumulation of inventory that comes from this distressed selling and whatnot. But, we have to be cognizant of all potential scenarios. So that's kind of what we're seeing in the housing market today. Again, it's still a market that more or less, mortgage originations down 30+%, home sales down 30, 40, 50% on a year-over-year basis. So you're in a low volume environment. That's going to hurt, the industry. It's going to hurt, you're going to see it feed back into the economy. We had Q4 GDP in Canada came at a big zero donut for Q4. That was below the Bank of Canada's expectations for 1.3% growth in the fourth quarter. So a huge miss. Obviously, gives the Bank of Canada a bit more ammunition in terms of their rate pause. There's probably a data point that the Bank of Canada is going, whew, after seeing this stickier than expected inflation, at least they can use, zero growth in Q4 as air cover for their pause. So But there's, like I said, we're watching monetary policy, interest rates being set by the rest of the world, inflation being stickier than expected, and this is causing the backup in yields again. You've got Canada's 5-year bond yield sitting at around 3.5%. That's getting close to the highs we saw towards the end of 2022. We haven't really seen those costs pass through by the big banks yet in terms of their mortgage rates. I think we're heading into the spring market, so banks are trying to be a little bit more competitive, gain a bit more market share into the spring market. So they're taking basically a lower interest margin, lower net margins, and trying to basically gather business in the spring market. But like I said, we'll continue to watch how this all plays out. But a couple things that I'm watching that I think are more concerns, 6, 12, 18, 24 months from now. Like we said, a lot of people will sort of hang on as long as they can, extend and pretend, so to speak. So see you next week.